Howdy. Um, Still Thursday, so we're gonna still make a video. I want to talk about something I researched today, which is called an income share agreement. So normally when you need to buy capital for something, need capital to buy something. For example, if you're starting a restaurant and you need kitchen stuff and pots and pans and ovens and whatever, usually you're able to go to a bank and get a loan, and the bank is okay giving you that loan because they know that at least in part, if you decide to default on your loan, that they can take all the pots and pans and ovens and stuff, sell them for money, and at least get part of their money back quite easily, and then get the rest from you later. Education is similar in a way, right? You are getting capital in order to make more money in the future. This is especially true for anything that's graduate school or vocational school. If I'm going to learn how to be a welder, it's capital in me, in skills, in order for me to learn to be a welder so I can make more money later. But banks aren't really keen on lending you money for this because they can't repossess your education. You have it, it's yours. If you default on your student loans, they're just out the money, and that sucks. And so in order to cover this, they have high interest rates, or they just don't do it in the first place. That's why the federal government does student loans. So an income share agreement is the other way of doing this. So for example, going back to our business, if you're starting a restaurant, another thing that you can do instead of just borrowing money is you can sell stocks in your money. So you can tell people, if you give me money now, I will give you a certain percentage of the earnings that I make with the stuff that I buy with your money in the future. And eventually I'll pay it all off, but this could go forever because it's a company. So the income share agreement is the same thing, but with people. You're selling stocks in yourself. So right now, Purdue University is the only place that I know of that does it. If you know of somewhere else, leave it in the comments below. So with the income share agreement, what you do is Purdue University, in this example, will give you money. Right now, they're not offering a large amount of money, but suppose it's $5,000. Purdue University will give you $5,000. It's not a loan. It's not a scholarship. It's not a grant. In exchange for receiving these $5,000 now, you promise to give them a certain percentage of your future earnings for a certain amount of time. And I think in most cases it's about 10 years, and it depends on your major. They look at what your average expected earnings is going to be based on your major in undergraduate. And so suppose it's 3% of your earnings. And so the way it works is after you graduate, you have 6 months before you have to make a payment, just like a normal student loan. And you, for the next 10 years, every month, you give them 2% of what you made that month. If you lose your job, 2% of 0 is 0, and that just counts for that month. And so your agreement ends either when your time expires and your 10 years are up, or actually I'm thinking about it now, it might be somewhere like 5 years, which makes it more realistic. In any case, somewhere in there. Or if you've paid back, given them more than 2.5 times the amount that you borrowed, there's a cap. And I think that's just really interesting that you can do that. And you can sell stocks in yourself. Some people think that it's somewhat like slavery, and it kind of is, except that no one's making you do it. This is a choice that you made on your own. You're allowed to take as much, in an ideal world, you'd be allowed to take as much capital as you want, and you bear the cost of you getting the capital. Anyway, hope that was a good Thurston Thursday. See you next week.